Assalamualaikum warahmatullahi wabarakatuh. Good morning, good afternoon, good evening to you all. We are now will be in our third video. This video will be on mostly on notes receivables. So let us start with the presentation here, and hope you will enjoy and be helped by this video in understanding the course. So, notes receivable actually it is a formal promissory note where it is a written promise for customer to pay some certain of money at a specific future date. So different from an account receivable, the notes receivable is based on a written promise, not based on oral account. It is called account receivable because it is an oral account, while this notes receivable because it is written. This is a negotiable instrument and maker signs in favor of a payee, and it could be interest bearing or has interest or without interest stated in the face amount or on the note. Where this notes receivable originate from? First, that it is because the customer needs to extend their payment into some period in the future of their receivable that is still outstanding, and this receivable, this notes receivable, is produced because it could be new customer that we or the company has, or because the customer is a high risk type of customer. Since they have to make a promissory note. Compare with account receivable where the receivable is made based only on oral account, for example, by phone or by an email, for example. This notes receivable must be based on a written note. It could be loans to employee or subsidiaries. It is because the sales of property, plant, and equipment, and could be from lending transaction. Okay, so here we can judge that the amount of notes receivable, individual notes receivable, could be more significant than the amount of a single account receivable, but could be not all of them will be like that, but mostly notes receivable is more significant amount individually. So to recognize notes receivable, there are two types of notes receivable. First one is a short-term one. The second one is the long-term one. If it is short-term, it means less than 12 months or at maximum 12 months. We must record it at face value, and then we deduct some allowance of it. And when it is long-term, we record at present value of cash expected to be collected. So you see here the differences is on the recognition of the notes receivable. If interest rate the stated rate equals to market rate, then it is issued at face value. Otherwise, it will be at premium or at a discount. This is the example of notes receivable issued at face value. Bigelow Land Scandinavian import of 10,000 euros in exchange for 10,000 3-year note bearing interest at 10% annually. So the market rate of interest for a note is similar risk is 10%. So the interest rate and the market rate is the same. So there will be no premium or a discount. So how does Bigelow record the receipt of the note? So here there are two cash inflow that the company will receive, Bigelow will receive. First one is the principal of $10,000 at the end of the third year. 10,000 euros will be received at the end of the third year. So we need to count or compute the present value of this 10,000. Since this 10,000 will be received later after the 3 year, and the second payment or cash inflow that the company will receive is the interest. The interest will be received 1,000 per year at the end of each year, as many as 3 years. So 1,000 will be received at the end of the first year, the other 1,000 at the second year, and the last 1,000 at the end of third year. So to recognize the amount of notes receivable, we have to calculate the amount of principal in the first year and the amount of this interest as of its first year. So we need to consult the table here, the table of present value of ordinary annuity of $1, the present value of interest of 10% in the third year. So we have here 2.48685. So it equals to 2,487 euro. You can see here that it is multiplied by 1,000. This factor is multiplied by 1,000. 1,000 is the amount of interest that the company receive or the Bigelow receive every year. So why 3? Because it is 3 years. Why 10? Because the market rate, not the interest rate, not the interest rate, but the market rate is 10%. So the 10% is the market rate. Well, present value of the principal is also 3 years and 7%. So it is 10,000 times 0.75132. It equals to 7,513 as the present value of 10,000 that the company received in at the end of the third year. So the amount of money, the value of the notes receivable actually is the sum of present value of interest and the present value of principal. Present value of interest is 2,487 plus 7,513 as the value of principal. It equals to 10,000. So the market value is equal to face value. So the net receivable on January 1, notes receivable of 1,000 is recorded, and the cash is as of 10,000. And December 31 of the first year, we received cash as much as 1,000 and interest revenue of 1,000. It is assumed that we receive cash here on December 1 or on December 31. Okay. So here on January 1, we receive account receivable and we pay some cash to the corporation. That here the corporation name was Scandinavian Imports. So the Bigelow lends 10,000 euros to Scandinavian Import. So the company received a record notes receivable of 10,000. So the other illustration where the Jeremiah company received a 3-year 10,000. Okay, let me use this. Okay, let me use here the company. Let us 10,000 9%. Okay, so the case here is that the company here on year zero 1, 2, 3, 2, and 1. They will receive 3 flow of income, of interest income. Each is 1,000, 1,000, and 1,000. And at the end of the 3rd year, they also receive this is interest. This is interest. This is principal. So the interest, the principal is 10 billion dollar or euro. So the company received a 3-year with 9%. So the interest is market price of the interest. I use it R as the market rate is 9%. So 9% is different, while the E interest is 10%. So the market rate and the interest rate or the coupon rate is different. So here we will use the same table. 3 years, 9%, it equals to 0.77218. So the value is 7,721.8. And then principal, where is the, sorry, this is the I'm sorry, this is a zero interest bearing notes. So since it is zero notes, there is no interest, zero interest bearing notes, so no interest rate here. So skip on my explanation earlier. So there is no interest received here, but it does not mean that the company does not receive anything here, but it is only not stated that the company will receive some interest. So the interest is included here in the amount of the principal. So the present value of only the principal that we have here. So we only record here the amount of carrying note. So at the date of the issue, so you take a look at this. Let me see. I have this one. Oh, I don't have. So look at this table. You must be accustomed to this schedule. The cash received, the first column is the cash received, second column is the interest revenue, and the third column is discount amortized, and the last one is carrying amount of the note. So the carrying amount of the note at the date of the issue is 7,721.8 is the carrying amount. Now, no cash received by the company, by the payee during the life of the notes. So what we need to do is to calculate the amount of the interest revenue to be recorded, since we need to add back the carrying amount to $10,000. So first we need to calculate the interest revenue. Interest revenue is equals to the market rate of the market rate of similar notes or bonds times the carrying amount. So it equals to 694.96 here. 694.96. So we also and then this interest revenue deduct with cash received, so we come at the same amount in discount amortized. And the same procedure we use here. So this one, carrying amount of the notes is equals to 7,721.8 include we edit with 600, this one 694.6 94.96, so it equals to 8,416.76, and then so on. We deduct it again until we have 10,000 here. This schedule is important since it will be used it will help us to record the journal. So the journal, the first year of the journal is that we record notes receivable of 7,720.80 and cash received as much as 7,721.8. And to record the interest revenue at the end of the first year, this one, 600, this one. So we add back notes receivable here. Our notes receivable only was only 7,721, and we add back our notes receivable as much as this interest revenue amount. So, and we go on until we come to the 10,000. So at the second year, the journal will be notes receivable of 757.51, and interest revenue is 757.51, and the third year will be 825.73 on notes receivable and 725.0 on not interest revenue. So if we have T account here, if we use T account here, we will have 10,000 of our carrying amount of the notes. Then we come to interest-bearing notes. Here we look at this one, this example. Morgan Group makes a loan to Mary Co. and receive and exchange a 3-year 10,000 notes bearing interest at 10%, but the market rate is 12%. So the market rate is 12%. This rate, as you know, it is used to calculate the present value of this principal and those interest. So the 12% of 3 years of present value of interest is equals to 1,000 times 2.40183. It equals to 2,402. It is rounded up, and the present value of principal, it equals to 10,000 times 0.71178, or equals to 7,118 euro. So the present value here, face value of the notes is 10,000, and the present value of principal is 7,118, and the present value of interest is 2,402. So the present value of the notes is 9,520. We have differences of 480 here. So we record notes receivable as 1,520, since it is the value of principal and the value of interest if we receive it today or at the date of the notes received by the company. And the cash that we pay is 9,520. Then we come to the schedule of notes discount amortization. Here, as you can see, the column 1 is cash received, and then interest revenue and discount amortized. We start with the carrying amount of 9,520 as we have it here. So this 9,520 is the carrying amount. So we start from here, cash received. At the end of the year 1, we receive cash as our interest as much as 1,000, and actually the interest revenue is 1,140. It is based on market rate of 12%. So the difference is the amount that we amortize as much. At the end of the third year will be as much as 480. So here we have amortization, discount amortized as much as 140. We, at the end of the first year, we also need to add the carrying amount of the note of 9,520 with the discount 142. It equals 1,662. and we continue it until the end of the third year. So we end it with 10,000 euros at the end of the third year. So the journal will be to record the interest revenue at the end of the first year. We record cash as much as 1,000 because it is the money that we receive, and the notes receivable of 142. Why we need to record back 142? Because we need to add it back until we come up with the 10,000. I will show you later why we need to record it that way. So here we look at this. Okay, let us use here. If this is the notes receivable, this one is notes receivable. We start our notes receivable with 9,520. 9,520. And at the end of year one, we add back with 100. We add 142. Year 2 we add 159 and 179. At the end of year 2, 159. The year 3, 179. So at the end of the third year, it equals to $10,000. So it is why we need to record back or add back notes receivable by the amortized discount. And then notes receivable that we receive for property, goods, or services. In a bargain transaction entered into at arm's length, the stated interest rate is presumed to be unfair unless there is no interest rate is stated, stated interest is unreasonable, or face amount of the note is materially different from the current occurrence. So in this case, we pay. We do not pay notes, or we don't buy the notes by cash, but by property, by giving them property or goods or services. So this is the example. Oasis Development Corp sold a corner lot to Rusty Pelican as a restaurant site. Oasis accepted in exchange of 5-year notes having maturity of 35,247 and no stated interest rate. The land originally cost Oasis 14,000. So Oasis sold the land that originally cost 14,000. At the end of the sale, the land had a market value of 20,000. So at the date of the sale, so Oasis used the fair market value of land 20,000 as the present value of the note. Oasis therefore record the sales as notes receivable 20,000, land 14,000, and gain from the sale of the land of 6,000. So in this case, Oasis sold a site or a lot to another corporation called Rusty Pelican here. So, and it received a note having maturity value of 30 35,247. This is the value of the notes at the end of the third year, not the value of the notes today, but at the end of the third year. Today, as of today, the land originally cost of 14,000. So since the Oasis sold it, so the land will be credited from its account as much as the cost, that is 14,000. And at the date of the sale of the land, the land had fair market value of 20,000. So the notes receivable is recorded based on the market value of the land, not by its market value, because we don't know the market value. We only know the maturity value of 35,247. So the Oasis will also record gain on the sale of the land as much as $6,000 here. And the last topic notes receivable is the valuation of the notes receivable. The company record and report short-term notes receivable at their cash realizable value, the same as account receivable. We also need to record our bad debt expenses and some allowance related to it, and it is pretty much the same with the trade account receivable counting. So we have other issues related to receivable. The first one is derecognition of receivable. So in terms of derecognition, it is when the receivable no longer has any value, or there is the contractual rights to the cash flow of the receivable no longer exists. For example, like this. For example, 5 years ago, I received a note from my customer, let's say company X. The company X promised me at the end of the 5 years, it will pay me a maturity value of, let's say, 100 million rupees. At the end of 2019, for example, the company report its bankruptcy, and the court and the judge of the court said that the company has already bankrupt. So the receivable has no value at all, because the company has no longer exists. So we need to recognize the receivable. Or it is when the company transfer or sells a receivable to another company. So the risk of the receivable and also the rewards has been transferred to other company. For example, because the company needs some cash, the company can sell its receivable to other company, so that the other company will collect the receivable, or the company itself could collect it for the other company that the company has sold the receivable to. So some derecognition of receivable could be in the form of transfer of receivable. The company can transfer receivable because it wants to accelerate the receipt of the cash. For example, for example, companies like telecommunication companies like Telkomsel, for example, they have receivables to their customers. Let's say 100 billion rupees. So the Telkomsel could sell the account receivable or the receivable to other companies like Bank BNI, for example, so that Bank BNI will collect the receivable uh, uh, that the Telkomsel has transferred it to Bank BNI. And could be because of competition, could be to sell receivable because of the money is tight, they need more cash, or the billing or collection are time consuming and costly. For example, like I told you before, if the Telkomsel as the company, this telecommunication company, needs to collect money, to collect a receivable from their customer, it could be more time consuming for them to collect it. They need people to collect the money, so they can sell the receivable to banks, and bank can collect it by their own expenses. So transfer of receivable can happen in two ways. First, the sales of the receivable, and by secure borrowing. So this is the principle of sales of receivable. This is customer here, could be retailer, could be wholesaler. This is the company. The company is the company where you has some payable. The company, the customer place the order, and the customer place the order to the company, and the company factor it to the. Let's say here the company is Telkomsel. Telkomsel has customer here. The customer receive services from Telkomsel. So the customer should have paid it to the company, but the company factor it to another company. It is called factor. This company will request will do some review on the credit request, and then if it is approved, then the company will the factor will give some money to the company, to the Telkomsel, and Telkomsel will receive the money, but all the customer payment will go into the factor, or could be the company itself, the Telkomsel itself collect the money to the customer and pay it to the factor. It is what happened in our credit card transaction. We as the customer shop to the company, but the company does not collect money from us, but we pay it to the factor, to the bank, while the bank pay it to the company. So it is the flow of factoring. Here, the factors are the finance company or bank that buy receivable from business for a fee. So the company here, for example, the supermarket will receive money from factor, and the factor will receive some fees from the company, and the payment of the customer will not go into the company but to the factor. This is the example sell with guarantee, where the purchasers it is where the purchaser assumes risk of collection. So the purchaser of the receivable will assume risk of collection and absorbs any credit losses, but also transfer its outright sale of receivable. So the receivable is theirs to have, and the seller records loan on sale. Seller use a due from factor receivable account to cover probable sales discount. So the purchaser is the factor, seller is the company. So the company use due from factor, or that is receivable, to cover some sale discount. This is the example, Crash Textile. This is the example. Crash Textile, a factor of 500,000 of account receivable with commercial factor. So the seller is Crash Textile, while the factor or buyer is commercial factors. On non-guarantee basis, commercial factors assess a finance charge of 3% of the amount of the account receivable and retains amount of equal to 5% of the account receivable for probable adjustment. Crash Textile commercial factor make the following journal for receivable transfer without guarantee. So there is no guarantee involved here. So you look at this two journal. First one is Crash Textile. The second one is commercial factors. The crash or the seller will receive money, and the commercial factor will pay some cash. So you look at here, since the Crash Textile factor is 500,000 of account receivables, so it will credit accounts or notes receivable, account receivable or notes receivable as much as $500,000. So what do they will debit? The first one is cash. They will receive some cash. How much is it? It is will be defined by will be deducted by some due from factor. It is kind receivable that the company has on the sale or on the factor of the receivable. It is 3% of the amount of receivable. So 3% of 500 is 5%. Return 5% equal 5%. So it is equals to $25,000. And some loss due to the sale of it. It is 3%. So it is 15,000. So the money that the company received is only $460,000. It is the journal on the Crash Textile, while the commercial factor journalized. First, they have account receivable of 500,000. It is the amount of account receivable that is factored, and then they have payable as much as 25,000 and some interest revenue of 15,000. So the cash paid on these $400,060. It is the example of sales without guarantee. And what about if they sell with guarantee? And then it means that seller guarantees payment to the purchaser, and the transfer is considered a borrowing, sometimes referred also as a failed sale or sale that is not happened. So you look at here. You look at it here that the cash is the same with sales without guarantee. It's 460. The liability, you can see the difference here. I have it side by side here. If you look at this account, this is recourse liability. It is liability here recorded here. It is not the sale of receivable. It is the sales of receivable, but with a guarantee. So it is liability as much as 500,000. While here, it is the sale without any guarantee that the receivable will be from the seller side. So the seller will will delete its account receivable from its book. So the seller record deduct its receivable. Let's say they have receivable of triple X, and then they deduct account receivable as much as 500,000 here. But here, no account receivable is recorded, whether it is credited or not. So we record only recourse liability as much as 500,000. Cash is the same, due from factor is the same, but here there is a finance charge, call it here. And the commerce factors at the company that buy purchase the sales, the account receivable is 500,000. Due from customer also the same, interest revenue is the same, so the cash received is much the same. So you can see that this is the only differences between these two types of sales of the receivable. Okay. And the other one is secured borrowing. Secured borrowing means the borrowing that is secured with collateral. For example, here on March 1, 2019, Mang Mills provides or assign $700,000 of its account receivable to Sino Bank as collateral for 500,000 note. So the notes is 500,000 and the collateral is 700,000. It is taken from its receivable. So Mang Mills continues to collect the account receivable. Mang Mills continues to collect the account receivable. The account debtor are not notified of the arrangement, so the customer are not notified on this arrangement between Mang Mills and Sino Bank. Sino Bank assesses a finance charge of 1% of the account receivable and interest note of 12%. Mang Mills makes monthly payment to the bank. So here, let us see. So this is the Mang Mills book and the Sino Bank book. The first one is transfer of account receivable and issuance of notes of March 1, 2019. So the Mang only receive cash. First look at notes receivable. It is credited as much as 500,000. It means the Mang Mills has no longer recorded its account receivable as much as 500,000. And at the other side, Sino Bank record not receivable as much as 500,000. So it is reciprocal. Okay. And then interest expense as 7,000. It is finance charge here 7,000. And then Mang Mills still collect the receivable from its customers. So, for example, here on March, $440,000 of account less cash discount of 6,000 is collected plus receipt of sales return of 14,000. So the cash collected is as much as 440,000 minus 6,000 as sales discount. So it is 6,000 as sales discount, and also some allowance, return allowance of 14,000. So the account receivable is then it is not sorry, it is not account receivable. It is notes receivable that the company, that the Meng has here. Notes payable. So notes payable and notes receivable. So and then Meng recorded account receivable here. When it is collected, the account receivable is deducted with 444 and on March, while Meng does not has any entry here on March. And then remitted March collection plus accrued interest to the bank on April 1, 2019. So Meng Mills send the money to the bank. So it send interest expenses. It record interest expenses of 12% times one month per 12 months. So it equals to 5,000, and notes payable of 434. So notes payable is deducted here as much as 434,000. Okay, and then on collection of April, the same new entry, and then notes receivable remitted again as much as 64. The remaining 66. So it equals to 500,000 here. So you can see here that notes receivable on there should be some notes receivable recorded here on April, deducted with 434,000, and then again on May 1 as much as 66,000. So it equals to 500,000. So the balance now is 0. The same with this one, the balance now is 0. This is the other example. On April 1, 2019, Prince Company assigns 500,000 of its account receivable to Hibernia Bank as collateral for 300,000 loans. So it receives money as much as 300,000, but it has collateral of 500,000 due on July 2019. So it is only for three months. The assignment agreement calls for Prince Company to continue to collect the receivable. So the Prince will still collect the receivable. Hibernia Bank assess a finance charge of 2% of the receivable. Interest of the loan is 10%. So instruction: prepare the April 1 journal, prepare the journal entry of Prince collection of 300,000 of the account receivable during period of April through June 30, and on July, Prince paid Hibernia all that was due from the loan. It's secure on April 1. So to prepare the journal, first we look at here the notes payable is 300,000, but the cash received only 300,000 minus the, what do we call here, minus the finance charge of 2%. So it is minus the finance charge. So the money received only 290,000. Then prepare the journal entry of for Prince collection of 300,000. So the Prince collect 300,000 as cash and account receivable 300,000. And then Prince paid Hibernia all that was due from the loan. It's secure, so it debit the notes payable as much as 300,000 here. So the balance of notes payable becomes 0, and the interest expense also paid as much as 10% times 300,000 times 3 months per 12 months. So it equals to 7,500, and cash of paid is credited as much as 307,500 dollars. So this is the summary of cash of receivable, transfer of receivable. Whether the variable is whether the risk is transfer or not. So this is the end of our chapter. The presentation and analysis will be you can cover it by yourself by looking at the slide or the book actually, and the practices that has been practiced by Indonesian corporation through your through the internet. You may check annual report of Indonesian corporation so that you can learn how corporation in Indonesia present and disclose its account receivable and notes receivable. Okay, this is the end of our session. Good luck with you all. Assalamualaikum warahmatullahi wabarakatuh.